Good afternoon, everyone. Welcome to the home buying presentation that we have for you today. We are really excited to bring you this presentation in partnership with Brigham and Women's Hospital in the Office of Employee Wellness and Engagement. Sarah Collins, I'm sure, will join us, and she is part of the Employee Wellness Office. And if you do have any questions specific to that office, don't hesitate to reach out to her. She is really looking forward to getting to know all of you and to working to better your wellness as employees. So whatever she can do, she's open to that. I'm going to get us started today. We have a lot to get through, so I want to get us to that information. First being logistics. You all have been muted as attendees because we want to make sure that you can hear our presenter first. And she will be going through this presentation, going through this information, and answering your questions. Just because you're muted doesn't mean that we don't want you to ask questions. There's actually a feature, either it says questions or chat, either on the right-hand side of your screen or the top navigation, where you can click and type in either questions that you have or comments, so that we know, number one, that you can hear me, and number two, that you know where that feature is. If you could go ahead and let me know where you're joining us from today, that would be great, so that way I know that you know where the questions feature is, and you know that you can hear me as well. Those are important things. Great. See that some people are joining us from BWH. Wonderful. Some people are joining us from Boston, from their homes. Wonderful. This is great to see. Thank you so much. This presentation will be made available to you all via our website. I will send out an email, or Daisy will send out an email tomorrow for you all to see this. So be on the lookout in your inbox for this from Daisy, so that way you all can go over this information again. And if you have questions about the information, you have Daisy's contact information. There is a short survey that we'll send out in the email as well. So please go ahead and fill out that survey for us and let us know how we can be presenting more information to you in ways that work better for you. So to get us started today, just telling you a little bit about the credit union. We are Harvard's not-for-profit financial institution. We serve all of the Harvard community, including you all at BWH, as well as all partner locations. So we have everything that a bank does, but we believe we do it a little bit better. Our focus is the Harvard community, so our products and services reflect that. And we're able to bring you services like this for free. Daisy is going to be our presenter today. She is one of our mortgage loan originators at the credit union, and we are so thankful to have her on board. So I'm going to hand it over to Daisy to get us started, and let me give her the mouse controls, but Daisy, take it away.
Good afternoon, everybody. Thank you for taking time out of your day to come and hear a little bit about the home buying process. The home buying process is going to be a lot, and it could change depending on where you're buying, what type of property you're buying, the community, and so on. So I'm just going to give you a little bit of a snippet of information. And if you have any other questions, please feel free to reach out to me, or we could set up a time to either speak over the phone, or you can email me the questions, or my contact information is going to be on the email as well. So you can text or whatever works for you. So the first part that we're going to go over is understanding your budget. A lot of people, when they're thinking of buying a property, they're thinking, oh, I just have to worry about the down payment. But buying a property is a little bit more complex than just worrying about how much you're putting as down payment. So when you're thinking of buying whether it's a home, like a single family property, a multi-family property, or a condominium, each type of property comes with its own set of caveats or basically rules and regulations that you may have to follow. So when you're buying a property, number one, your credit affects how much you may be able to borrow, And depending on the institution, it affects your mortgage rate as well. And if you're putting less than 20% down payment, where you're going to need private mortgage insurance, or if you're thinking of going with an 80-10-10 mortgage program, your credit is going to impact whether or not you're eligible for either, depending on how much private mortgage insurance, or whether or not you're eligible for certain mortgage products. Your down payment also affects how much you may be able to borrow, how much of a property you may be able to purchase. And lastly, the debt to income ratio. At the credit union, whether you are a member of the credit union or because you're part of the Harvard community, we have basically the credit union pays for a program to help you with your budget and to help you with counseling, and this is called Green Path. You can set up a time to speak with them. They're available basically from 8 a.m. to 10 p.m. Monday to Thursday, or 8 a.m. to 7 p.m. Fridays, and even on weekends on Saturday, they're available until 6 p.m. So one of the first questions that I get from people is, um, I have X amount of money. Should I pay off some debt or should I save that for the down payment? And honestly, that depends on what's going on with your credit. Sometimes it may be best to pay off debt so that way you have a lower debt to income ratio. You don't have to worry about the payment depending on the debt, whether it's a credit card, a vehicle loan, or a student loan. Sometimes it may be more advantageous to you to basically put the money as a down payment. That way you have a lower PMI premium if you put in less than 20% down payment. So this is just an example. Let's say that you are borrowing $400,000 for a mortgage. You have student loans in the balance is approximately $50,000. Overall, if you're putting, let's say that you put in $50,000, um, so in this example, so you have $50,000 in student loan, but let's say that you pay down $10,000, and instead of paying it to the mortgage, you pay it to the student loan. The amount that you're going to be paying in finance charges, if you look at the difference, is lower. But if you're thinking of, let's say that I'm going to put $10,000, instead of putting it to the student loans, I'm going to put it towards the mortgage. The savings, the difference in savings is approximately $3,000. So in this case, it may be more advantageous to you to put the money towards basically the mortgage instead of putting it towards the student loan. But then again, it depends on the situations. Sometimes you may need to pay down your student loan so that way the minimum payment due is lower, so you may qualify for the mortgage. And in this example, we're just giving you a brief example of basically how much it will cost you if you put 20% down payment versus 5% down payment. In some instances, depending on how much money you have, you may not have a choice but to put the 5% down payment. But because we are the type of loan that we're offering, instead of like if it was an FHA mortgage, you will have private mortgage insurance or mortgage insurance for the life of the loan, regardless of whether you put 20% or 5% down payment. Because our loan is basically a conforming mortgage, once you reach 20% down payment, you have the option, as long as you be making payments on time, you will have the option to have the private mortgage insurance premium removed. So if right now you only have 5%, don't let that deter you from buying a property, because if you come into money, if you're thinking you're going to come into money, you're able to be more aggressive with the payments and you may have the private mortgage insurance removed. So in this example, it will let you know that if you put 20% down payment, you don't have the additional cost, which is approximately $165 per month in private mortgage insurance. But at the end, because you add in that additional cost of private mortgage insurance, if you put less than 5% down payment, what you need to have in reserves, and reserves is not money you're going to bring to the closing, but rather money you have to have set aside in an account, whether it's a retirement account, savings checking, in case of emergency, in case, God forbid, you lose your job, you need to have at least 2 months worth of housing payments so you can cover the payments until you get you back on your feet. What are closing costs? Closing costs are essentially the fees that you're going to have to pay to get into the property, to buy the property. Once you submit a mortgage application, typically the lender will send you what is called a loan estimate. And the loan estimate essentially is just for budgeting purposes, so you can have an idea of how much money you're going to have to bring to closing. A lot of times the loan estimate is higher than what you're actually going to need once basically the underwriter, the processing team, and the closing attorney reviews your file. Aside from paying the fees that you're going to have to pay, you also, depending on the type of loan product that you get and depending on how much you put as down payment, you're going to have to establish an escrow account. You don't have to. It's not something you have to do yourself, but it's something the lender would do. And the escrow account essentially is a savings behind the scenes of your mortgage so that we could collect money from you to pay your property taxes. Sometimes the lender will collect money to pay your homeowner's insurance and also your private mortgage insurance if that's applicable. So essentially, how much you need to bring to closing depends on a few factors. One is the down payment. So obviously, the larger the down payment, the larger you will have to bring to closing, and vice versa. If you're putting a lower down payment, then the amount that you have to bring to closing is going to be much lower. Other costs to consider, aside from the closing fees and the down payment, is things that are aside from buying your property. If you choose to have a home inspection, the home inspection is basically somebody like a licensed home inspector going to the property before you buy the property to make sure the property is sound and it's not going to have any major issues. Like the property is not going to have termites, and that everything is working properly so that you can move into the property. Another cost you're probably going to have is an attorney. You have the option of hiring an attorney to help you with the review and execution of the purchase and sales agreement. For the closing transaction, you're required to have an attorney, but if you don't have to, you have the option of not having an attorney for the purchase and sales agreement. Honestly, if you're a first-time home buyer, it's a good idea to have an attorney, or if you're buying a condominium, just because you want to make sure that they review all of the condominium bylaws before you sign a contract and are more committed to the transaction. Other costs to consider will be basically homeowner expenses. You may want to have some reserves in case, let's say, after you buy the property, something happens with the heating system or for moving expenses, or you may want to buy new appliances and new furniture for your new home. Aside from credit and aside from your down payment, one big factor that affects how much you may qualify for a mortgage is the debt to income ratio. And once you are more serious, I will say, in the buying process, you may hear this term a lot. The debt to income ratio is essentially all of your monthly expenses, whatever shows up on your credit as a minimum payment for credit cards, student loans, vehicle loans, personal loans, excluding utilities, divided by your monthly income before taxes and deductions. Once we calculate that, we're going to get a percentage. Typically, the standard is that for all of your expenses, including the expected expenses for the property you're going to purchase, that number cannot exceed 43%. Um, but then for the housing, the standard is that you want to have no more than 36% just for housing expenses. So principal, interest, property taxes, condo fees, insurance. that number divided by your monthly income before taxes and deductions. We want to make sure that that number doesn't exceed 36%. But there may be room for exception. Let's say that you don't have that much debt. We may be able to combine, go up to 43%. If the only expense you're going to have is for housing, you may be able to go up to 43%. Some items that are excluded from the debt to income ratio, as I mentioned, is utilities, childcare, your water bill, tuition payments. So even though student loans are included because that shows up on your credit, if you, let's say that you are paying tuition payments, you may want to keep that in mind. And again, for the debt to income ratio, for the purposes of calculating the debt to income ratio, we use the income, the monthly income before taxes and deductions. But that doesn't mean that you don't have those expenses. Just keep that in mind. So when we do run the calculation, we'll let you know how much you qualify for, the highest amount that you may qualify for, but keep in mind that maybe you want to contribute to your retirement account. Maybe you want to take a few vacations and so on. So just keep, you don't want to be house poor. So just because we let you know that you may qualify for $1 million, it doesn't mean that you want to buy a property for $1 million just because you still want to do all the things with your money. So an example of debt to income ratio. So let's say that your income per year is $50,000. So the gross monthly income, so the income before taxes and deductions, will be 4,167. If your monthly payment for all of your expenses, including housing, is 1,892, then your debt to income ratio will be 45.4%. But now let's say that your yearly income is $80,000, which means that your gross income will be 6,667. If your total expenses are 1,892, then your debt to income ratio will be 28.4%. But now let's assume you want to buy, you have more expenses, or you want to buy a larger property. If your income is 4,167 per month, that divided, so 2,331 in total expenses divided by 4,167 will give you a debt to income ratio of 55.9%. But then if your income is $80,000, which is per year, and 6,667 per month, then this number divided by this will be 35.5%. Other items to consider once you're thinking of buying a property will be you want to know the market. Typically, right now in the spring, I mean, right now it's a little strange because of what's going on with COVID-19, but typically in the spring, there's a lot more properties on the market, there's more inventory. However, there's more competition because for some reason the spring market is basically typically when the bulk of the volume for mortgages happens. And that could be because the spring is nicer and a lot of people, the houses look nicer when it's sunny out, there's no snow and so on. Then in the fall, typically in the fall, there's not a lot of inventory, meaning there's not a lot of properties put on the market. But that's when you may have a chance to negotiate on the price, especially if it's like in the dead of winter. You may so typically people that are sell their property in the dead of winter is because they may be more of a motivated seller, somebody that wants to get rid of the property because of a X, Y, and Z reason. So you may have an opportunity to get a better price on a property than if you were to buy in the spring when there's more competition. Right now, surprisingly enough, in spite of what's going on with COVID-19, um, there is not a lot of inventory because I believe a lot of people are fearful of selling their property. So right now, I would say it's more of a seller's market, depending on when you're buying. If you go to like Western Mass, you may be able to get a better deal than if you were to buy, let's say in the city in Brookline, Somerville, Cambridge, and so on. So right now, even though we thought like basically the purchase market, it was going to be cooler just because of what's going on with COVID-19, that is not the case actually. But I've seen an uptick in home buying, but there's still a lot of competition. So I would say that right now it's more of a seller's market. And financing is still, your people are still able to get mortgages, but there's a lot of more restrictions because there's a lot of fear of people losing their job and so on. So whereas let's say a couple of years back, it may have been easier. You may not have to supply a lot of documentation to prove your income and prove your assets. Now, because of what's going on with COVID-19 and people losing their job and the higher rate of job loss in the nation, um, basically it's going to be, we're going to require to verify income and asset more strictly, and there's going to be more documentation required. And like I said, because there's not a lot of inventory right now, there's typically multiple offer situations, especially in the city, or especially near like school, like colleges, or near the hospitals. Another item you may want to consider when looking to buy a property would be to know the loan products. Um, if you're thinking of buying a property that's over 690,000, just speaking for the credit union, there may be different requirements depending on the lender and depending on the city and county where the property is located. So speaking for the credit union, right now a jumbo mortgage is a loan amount for a one family property over 690,000. In some places, depending on the county, like if you were to buy in Western Mass, because typically the house prices further out are a little lower, a jumbo may be a mortgage that is over $500,000. Some of the main programs are conventional. This is what the credit union offers. There's also FHA loans. FHA loans are typically for borrowers that have a lower down payment than 5%. Um, the FHA loan requires you have at least 3.5% down payment. Um, in the past, it used to be that FHA loans were allowed a credit score of below 600. Um, but right now, because of what's going on with COVID, the minimum credit score, if you want to qualify for an FHA loan, is 660 points. There's also veterans loan. The veterans loan, basically, you have to be a veteran. One of the borrowers has to be a veteran or have served in the service.
Hello.
Hi, Daisy.
And
We had
then,
a question that came in.
sure.
Okay. So the question that came in, and I think you spoke a little bit about some of it, but specifically they were asking, um, aside from the additional documentation, what else has changed with COVID-19 and the overall home buying process, open houses and such?
So aside from documentation, a lot of open houses have now gone to being virtual open houses. You may like if you go into Redfin, you may see that they have an option to, or Realtor.com or even Zillow, they have an option to view the property virtually. Whereas before, you can go in, they were having open houses in the weekends during the week, and you can go in. Another item that may have changed because of what's going on with COVID-19 is that now, in order for an agent to show you a property, they require for you to have basically be a serious buyer. Um, Whereas before they would show the property to anybody, somebody that was like just browsing and shopping around. Now they require that you show them that you have been pre-approved by a lender before they show you a property. Just because basically now there's more restrictions and it will be like they're more limited as to how many people they could have in open houses and so on.
Another question that came in, is now a good time to buy?
I think it is. I mean, if you're able to find a property that you like in a good area, so a lot of people are fearful that maybe the property prices are going to go down. But honestly, even back in 2008, when the market crashed, around the city, like Boston, Cambridge, um, that they were not as affected as somewhere else in the nation, like Nevada and so on. So buying a property, I mean, in my opinion, it is a good time to buy because either you're paying rent, you're paying somebody else's mortgage, or you're paying for your own property. And eventually, even if the prices go down, unless you're thinking of selling the property within 2 years, if you're thinking of being in the property for at least 5 years, eventually everything balances out and the prices will continue to increase.
Thank you. Another question that came in, once you have been pre-approved by a lender, how long do you have to find a house?
So every lender has their own different requirements. Speaking for the credit union, the pre-approval is good for 90 days, 3 months. However, if you're actively looking for a property and by day 85 you to say, I'm still looking, we may be able to extend the pre-approval. We're going to need to verify your income and assets, but we may be able to extend it without having to check your credit for another 90 days. So in essence, you may have a total of 6 months to buy a property. Some lenders, the pre-approval expires after 30 days, but again, it depends on every lender has their own set of rules and regulations. Are there any more questions, Migdalia?
I'm going to turn it over to Sarah. I think there were a couple of additional questions, so I think I'll turn it over to Sarah because I know she can manage the questions and then the remaining slides that you have.
Okay, thank you so much.
Sarah Scruggs, I should specify.
Yes, thank you, Migdalia. Sorry about that. Daisy, there is another question. How much of your income or how long do you recommend saving for a down payment? This person is saying, like, for example, should we keep income saved easily available or should we invest it for retirement and possibly use that for a down payment? So really just kind of wondering about how to save for that down payment.
I mean, if you're getting a better rate of return by saving the money in retirement, you may want to talk first. You may want to talk to a financial advisor just to make sure, because I'm from my past experience, and I've been doing this for almost 20 years. You are able to use, if you're a first-time home buyer, money that is in a Roth IRA or a traditional IRA, but I'm not 100% sure what the tax repercussions may be. So you may want to talk to a tax advisor. And then if you're getting a better rate of return in a retirement account or if you're investing, then save it there. But then once you're close to buying a property, you're going to have to move the funds to either a checking account, a savings account, or a money market savings account because we're going to need the funds to be in liquid funds.
Thanks, Daisy. I think, yeah, I think always talking to a tax advisor about things regarding retirement is very important when you're thinking about possibly using those for something other than retirement. The next question is, with an FHA loan, is the PMI for the life of the loan?
Correct. So FHA, because again, FHA is typically for like more of a low income borrower, or somebody that has a low down payment, what some people do is that they go into the FHA loan, buy the property, and then once they have enough equity in the property, they refinance to a conventional mortgage product, because that way you can get rid of the mortgage insurance premium. But typically with the FHA, and unfortunately at this time of the credit, we don't offer FHA loans, but typically with the FHA, you have to pay a mortgage insurance premium upfront, and then you have a monthly premium depending on type of property, your down payment, and so on, that you have to pay every month for the life of the loan. So if you're getting an FHA mortgage for 30 years, you're going to have to pay private mortgage insurance for 30 years, regardless whether or not you reach the 20% available equity.
Thanks, Stacey. Another question. If I get a pre-approval now, but don't end up buying within those 90 days, does it look bad to get another pre-approval later on?
It doesn't look bad, but it all depends. So every time you do a pre-approval, we have to do a hard pull on your credit. So it doesn't necessarily look bad, but depending on what else is going on, it may affect your credit score. Um, Typically, if you are applying for a mortgage product, whether it be a pre-approval or you're applying for to refinance or a purchase transaction, if you do it within 30 days, like if you do all of your credit increase or have credit increase within 30 days, that only counts as one. But after that period, anytime you have your credit checked, it's going to be another hard pull on your credit, and it could, depending on what is going on, again, it could affect your credit rating negatively. And the only, as far as the credit rating is concerned, your interest rate is not affected by credit rating. But if you're putting less than 20% down payment, private mortgage insurance, the premium that you're going to pay for that is affected by your credit rating. The lower the credit rating, the higher the premium.
Thanks, Stacey. I think this kind of goes right into what you were saying. So it says, how are different mortgage rates different across lenders? Are rates more likely to vary with time and national interest rates, or is there just like big changes in between, like the credit union versus, another bank? So how are different mortgage rates different across lenders?
Sure. So, I mean, right now is a little, the rates have been back in 2009, 2008, when the market crashed, the rates were like in the twos for 30 years, which is unheard of, but also the property values were low. Um, right now, so the rates are lower than they've been in a couple of years, but each lender may have their own basically appetite to get new mortgages. So some lenders may give you let's say 2.5%. A lot of times you're going to pay for that rate in the form of points or administrative fees. Some lenders may have a 3% rate. It all depends on the product. Um, some lenders may charge you a higher rate depending on your credit rating, depending on basically the risk that is assessed to the property, whether it's a condominium or a single family home, and also depending on how much of a down payment. Some lenders, if you put in, let's say, 25% down payment on a purchase versus somebody that's putting 30, the person that's putting 30% down payment may get a lower rate than that person that's putting 25. So it varies depending on the lender, but they're pretty similar because mortgage rates are driven by macroeconomics, basically what's going on in the nation, versus like a rate for a home equity or a vehicle loan is more driven by prime rate.
Thanks, Stacey. I think that was really, a really interesting point that you made there. They're driven by macroeconomics for home prices and home interest rates. So I know that this has changed recently, so I do want to ask this question. If I want to buy a multiple family home, but I don't have the income requirements to access the larger amount of loan, would the lender use the rental income or projected rental income?
So that is something that has changed in years past or in months past before prior to COVID. We were able to use the projected rental income. Let's say that you're buying a two-family property. as part of your income. Right now, in order for us to be able to use the projected rental income, you have to have experience being a landlord, somebody that's had rental properties before. So if you're a first-time home buyer, um, typically you basically need to be able to afford the property based on your income.
Thanks, Daisy. And last one before I want you to keep going with your slides, and then we'll have some time for questions again at the end. But this person is asking, does a conventional loan always require a 20% down payment?
So a conventional and even so you're not required to have 20% down payment. It's just it all depends on the loan product. You may be required to have private mortgage insurance. So you, depending on the loan amount, um, at the credit union up to if you're borrowing up to $1 million, you are able to put as low as 5% down payment as long as you qualify for private mortgage insurance. But we also have another loan product called 80-10-10. Depending on your credit rating, you may be able to get a first mortgage for 80% of the property value, put 10% down payment, and then get a second mortgage for 10% of the property value. And that sometimes that is cheaper than paying for private mortgage insurance. Um, Sometimes it's the other way around. Sometimes it's cheaper for you to pay for private mortgage insurance, especially because we're not for profit, we're a credit union, and you typically get a discount on the PMI. And also, if you're a first time home buyer, you get a discount on the PMI for being a first time home buyer.
Thanks, Daisy. Those are all the questions for now, but if you have more questions, please continue to put them in the questions or chat panel, and we'll get to those when Daisy finishes up with her slides.
Thank you, Sarah. So we're going to go, I know we went over this a little bit in the questions, but so as I mentioned before, so the economy, the macroeconomics affect the mortgage rates. Depending on the lender, your credit also affects the mortgage rates. And typically, if you're applying, you may be able to apply with up to 4 people on a mortgage. Um, the depending on the institution, the rate is based on the person that has the lowest credit rating, basically the perceived risk. Um, and the same is for mortgage insurance. As I mentioned before, the credit union, your rate is not affected by credit, but private mortgage insurance is the premium that you pay per month. So if you're applying with another person, we will look at the joint credit, and the PMI premium is based on the applicant that has the lowest credit rating. And as I mentioned before, so depending on the lender, somebody that is buying a single family may get a lower rate than somebody is buying a multi-family home or a condominium. It also depends on your down payment. So some next steps that you may want to consider are just doing your own research. A lot of times, so when the lender is looking to see whether they could lend, aside from your financials, debt to income ratio, credit, how much you're putting as down payment, they look at the property value. And the way the property value is assessed is based on the condition of the property you're buying in comparison to the other properties have sold recently in your area or the area where you're thinking of buying a property. So you may want to research the community just to get an idea. Another reason why you may want to research your community is so that you can see whether or not you want to live there. One advice I give my clients is if you have time, take a drive around the area when everybody's supposed to be at work, like during the week, so you can see, and that will give you an idea of crime rate. Because if you see a lot of people unemployed or just walking around, and I know now in time of COVID, that may not be the case depending on the area, but that will give you an idea of the crime rate or how many people are unemployed. Um, having a good team help you through the transaction could make or break your deal. So another advice I give people is interview real estate agents. You can get an idea how, like, your personalities jive, or if somebody's going to be responsive. A lot of times you may see an agent that's, let's say, the top agent, number one. That could mean that the agent is very good, very responsive, but it could also mean that the agent is very busy, and that they may not have too much time to answer all of the questions that you may have. So a good way to have a good team is basically interview them, just have a conversation with them just to get an idea of their experience and also get an idea of how responsive they're going to be throughout the transaction. The reason why that is important, um, number one is once you make an offer, you want the agent to be diligent to basically get the information to the seller right away, because that could make or break the fact that, or that could mean the fact that you get the property or not. So if the other person, if there's like a multiple offer situation and the other person has an agent that's diligent, submits the offer, and then the seller may be willing to accept the offer, but if your agent is very slow in getting the offer to the seller, you may lose a transaction. Um, Another step that you want to take is attend a home buying session, like such as this one. We have another home buying workshop that goes a little bit more in detail with everything that transpires during a transaction. But just attend as many workshops as time allows and as you can, just so you can get an idea. Another option, it will be to estimate the closing costs. The closing costs are not going to be 100% accurate because, again, there's a lot of unknowns. But this way, you can get an idea of how much you need to prepare for closing, and so you can better manage your budget. Um, so if you go to huecu.org/calculators, on there you see a link, so you can enter the city, county, type of property, and so on, so you can get an estimate of what the closing fees might be. Another step, even if you're super early in the process, that you might take, is meet with a home loan officer, such as myself or any other of my colleagues, just so you can see how prepare or how to better prepare to buy a property so you can do it right. Um, you have the option, even before the pre-approval, of doing a pre-qualification. The pre-qualification is basically you having a conversations with a licensed mortgage loan originator, giving them basically information on what you have as expenses, and your income to see how much you may be able to qualify for. And by having this conversation, the loan originator may help you determine whether or not you want to pay off some debt or whether or not you want to be more aggressive in saving for the down payment. So that would be, in my opinion, that would be the first step you might want to take, is meet with somebody, whether it be on the phone or in person, just to get an idea of where you are in the process and what steps you should take.